Nicholas Bornolis of Capital Link, I would like to welcome you to another extremely interesting panel discussion of our forum today. And this panel is going to deal with the topic of company strategy and capital allocation. So we are going to discuss issues like multi-sector strategy versus single sector strategy. What do you do with your capital? You buy debt, you buy back shares, you pay down debt, you give dividends. How do you use your cash flow for the company's development and growth? We have with us a great group of panelists. Ted Horton from Seward and Kissel is going to moderate, and I'd like to thank Christa, Hamish, George, Jerry, and John, and Ted. The floor is yours, and thank you very much.
Well, Nicholas, thanks very much. Always happy to be here. I'd like to just briefly introduce the panelists today in no particular order than just as they're appearing on my screen. We have Hamish Norton, who is president of Star Bulk Carriers. George Achniotis, director and executive vice president of business development at Navios Maritime Partners. Jerry Kalogiratos, chief executive officer of Capital Product Partners. Where's next? We have Christa Volpicelli, who is managing director and head of maritime investment banking at Citi. And last but certainly not least, John Wobensmith, who is in my lower right, CEO of Genco Shipping and Trading. As Nicholas said, the topic today is on corporate strategy, and I think with a focus on capital allocation in today's markets. Where we are in March of 2022 is we've obviously seen a very strong rate environment in shipping, at least in a number of sectors of shipping for 2021, and to some extent continuing into 2022, which has resulted in companies reporting very strong profits or revenues for 2021 and significant cash positions on the balance sheets as of year end. That's tempered by the fact that we obviously do have continuing uncertainty and volatility resulting from continuing COVID issues, particularly I think the news that is coming out of China this week, and obviously also attributable to the war in the Ukraine and the West's economic response to that, which is certainly a level of uncertainty that wasn't anticipated 2 months ago. What I'd like to do is just start with a general question on the capital allocation. I think there's certainly a common theme, including from a number of the panelists here today on delevering and on shareholder distributions. I'd like to come back to those a little bit more specifically, but also just as the first question is just sort of start by asking as to what are the other sort of uses or considerations that go into capital allocation policies that you're making in today's environment. Hamish, maybe I'll again just start with you from where you are on my screen.
Well, it's obviously a big topic, and I don't want to take up the whole 45 minutes, but basically we're in a situation where we don't particularly want to order new building dry bulk ships because basically the financial attractiveness of new buildings just isn't there given the price of the new buildings and the forward rate environment. And also the new building you would order today is almost certainly not the ship you want to own in 2030. And so basically, if we're not ordering new buildings, we want to use our cash for debt repayment, dividends, and to the extent our share is usable, at a price that's attractive relative to ships in the water, we have been and would like to continue to be able to use our share to acquire ships in the water. And maybe I should leave it at that and allow some of the other participants to give introductory remarks on how their company is thinking.
Okay, if I may follow up, Hamish. At the Navios Partners, we went through a deleveraging process in the previous years. And today we sit in a modest loan-to-value level, which we intend to maintain going forward. So our focus in the recent quarters has been to allocate capital for M&A activities and for fleet renewal. So last year we merged Navios Partners with Navios Containers and Navios Acquisition to create a diversified asset portfolio. I mean, we have been in the public markets for more than 15 years now, and we created small, three separate pure play companies that pay the dividend. And at some point, we realized that this model is probably not suitable for our industry, which is cyclical and very volatile. And that's why we refocused in merging the three entities. We did then block transactions, which allowed us to get immediate scale. And we diversified this asset in three different segments, which protects us against specific sector swings. And the other area that we have allocated some capital is on fleet renewal. This is an ongoing process. Navios Partners now has a fleet of over 140 vessels. So just to maintain the same average age of the fleet, you have to replace 7 to 8 vessels every year. So that has also been part of our focus for last year.
John, maybe just touch on the other uses you focus on.
Yeah, happy to jump in there. So first of all, I agree with Hamish 100%. I'm glad he actually came out of the box on the new building front. You know, we don't feel it's right to put capital into new buildings either at this point for a variety of reasons. So what we have been focused on is our comprehensive value strategy. We did a tremendous amount of delevering last year. We paid off almost 50% of our outstanding debt from the beginning of the year through the end of the year. So we're down to a net debt of about 15% on a loan to value basis. And, you know, we're really targeting a net zero debt as we get towards the end of 2023. So we have set up a run rate to repay about $35 million voluntarily this year and probably going into 2023 as well. We don't have any mandatory amortization at this point because of all the debt that we have paid off. So we're going to be focusing on dividends. We've driven our cash flow break-even rates down into the low $8,000 a day, and which means that we can pay out quite a bit in dividends and hopefully drive valuation for Genco going forward. The other two items that we'll probably focus on is fleet renewal, similar to what we did last year in terms of selling our older, less fuel efficient vessels and redeploying that capital into newer, more fuel efficient ships in both the Capes and the Ultramax sector. And then we have CapEx. We're going to be spending quite a lot on 2023 type upgrades to comply with CII. And as I've said before, the great thing about that is from a regulatory standpoint, it's necessary, but there is a true return on capital of that because you're decreasing your fuel expense.
Jerry, of course, they're doing fire drills in my office as I'm doing this panel, so I apologize for the background. But Jerry, just before moving on, maybe just want to comment on, again, sort of your perspective on where the uses are focused.
So in Capital Product Partners, we have now over the last 15 years that we have been a public company, balanced growth with returning capital to unit holders. Actually, I think we are among a handful of shipping companies that have been paying non-stop distributions to unit holders for such a long period. I think it's 59 quarters of non-stop distributions amounting to just short of $1 billion. The way that we have been able to achieve this is because our business model is very conservative. Firstly, we have focused on diversifying our fleet from early on, back from 2010. Secondly, we have been active in managing our exposure depending on the outlook of each market. Thirdly, we have been very protective of the balance sheet. We have always retained a strong balance sheet, but at the same time, we have always acquired assets with long-term charter coverage and with staggered expirations. So this has allowed us to generate free cash flow that we could share also with our unit holders. We have never had issues with a balance sheet, not even a covenant waiver. And that has given us strength to continue to grow and return capital. So nowadays, we also have a unit buyback program in place, which is quite accretive, quite valuable, as we are taking advantage of the valuation dislocation. But I think together with the current distribution, we are well positioned to also grow in the sectors that we have chosen, which is the LNG and container sectors. We do believe that one has to continuously replenish the fleet and the earnings capacity of the company. And at the same time, I do think also that the market at this point does not fully reflect in terms of asset valuation the adverse impact that the regulatory framework is going to have on older ships. So investing in modern ships, be it new builds or very modern ships, it's very important. And to the extent that one can take advantage of the market, opportunistic divestments of older ships would also make sense.
And you've all, and Hamish, I think you touched on a number of the topics in one question when you started, but one that you've all focused on, and Hamish, as you put it, in the vessel that you buy today may not be the one that you want to own in 10 years. I mean, with so much focus on the environmental issues and call it the uncertainty around sort of tomorrow's technology, how does that impact decisions regarding fleet renewal or growth in terms of what you're looking at? Is it not, you say not buying new buildings, Hamish, Jerry, you're referring to the new buildings. What are you looking at in terms of the allocations into the technology when you can make a decision?
Yeah, I mean, look, it's a huge and complicated question. I think for the moment, nobody really knows what technology is going to win out and be, the next step in decarbonizing, at least dry bulk ships, which is what we're paying attention to. Frankly, what seems to be becoming more and more practical, which surprises me, is actually carbon capture, which may extend the life of traditionally fueled ships. Until relatively recently, I had assumed that the next step would be moving towards ammonia. But ammonia is not a retrofit. Ammonia would be a new building. And of course, you cannot order an ammonia-fueled ship at this point. So, I think our inclination is that when it makes financial sense, we would probably renew the fleet with modern, secondhand ships until it becomes more clear what actually to do with decarbonization. And of course, at the same time, we're planning to invest a fair amount in energy saving devices and things like hull cleaning robots and fancier bottom paint. Basically the two things you can do to save fuel are to go slower, which is a huge effect, and to keep your hull clean. And the difference between a clean hull and a dirty hull can be 20, 30, 40% fuel consumption. It's huge.
We operate in an industry that doesn't get any subsidies from anywhere. unlike other industries like the airlines or the car industries that get subsidies for R&D. So in terms of the future fuel, I think we have to be patient and wait to see what will be the new long-haul fuel that will be developed for airplanes and cars. And then most probably we'll have to adopt that. But I don't think shipping as an industry will be proactive in developing a new fuel.
Christa, maybe if I can sort of come to you and come back on the well, maybe it's on the shareholder distributions, maybe it's not, but from the perspective of an investment banker and from the investor's perspective, and they're seeing significant, the cash balances as of year end, what are you seeing that investors are either expecting or would like to see from issuers as to what they do with that cash? And I guess maybe I would, sorry, if I may, I just add one is that, we're hearing it's also keeping in mind is sort of from value enhancement from the shares from stock price. And I guess the question is sort of how important is those distribution allocation decisions on stock price, given that, Hamish and I know, Jerry, everyone sort of used their stock for either all or some of their growth over the last several quarters.
Absolutely. So I do think that shareholder distribution policies and dividend decisions are very critical to support the share price. But I think that it has changed a lot over the last 10 to 15 years in the capital markets for shipping. And I think all of the companies who are here and who talked about their dividend policies, they're very different than many companies in the shipping sector thought about a while ago. And specifically what I mean by that is investors care about a dividend policy which is clear and understandable, a dividend policy that works with the capital structure of the company and is sustainable. Now, of course, when you have a formulaic policy in a cyclical sector, that doesn't necessarily imply the same dividend level over time, but it's a dividend level that's appropriate for the cycle that we are in. And it's a dividend level that's appropriate for a company that's thinking about keeping financial flexibility, maintaining its fleet as assets age, and being able to service all of its debt and obligations. So I think that that's what's most critical that investors want to see. I do think that dividends are important in shipping. They always have been. It's a cyclical sector. In the most cyclical segments of shipping, investors would prefer to get the cash back than have it build on balance sheet. Interestingly, and I'll mention the tanker sector because we don't have any pure play tanker companies on this panel. When you look at how companies are thinking about balance sheets and liquidity, you do see some of the smaller cap tanker companies, the liquidity that they tend to hold on balance sheet tends to be a larger amount as a percentage of their market cap, simply because I think it provides them with that insulation through the cycle. So all of these policies have to make sense in terms of the size of the company and the capital structure, but no question dividends are important. I do think that, when you also talk about some other segments, such as the shipping liners, as an example, there you have business models that, are not just shipping, but they're also logistics. And these companies have made a lot of money over the last year. And they're using that capital not only to pay dividends, but also to diversify and to grow. But that's a bit different than the companies we have here today.
And just as a follow-up, Jerry, you had mentioned the buyback is in terms of dividends versus buybacks. Do you see that, I guess, one, is there a significant difference on sort of share prices or as investor, appreciation for one over the other? Maybe Christa, start with you, and then curious to get others' views on that as well.
Dividends versus share buybacks. It's a tricky decision in this sector. I think it's gotten a bit easier as we've seen values appreciate over the last 1 to 2 years in terms of the equity values. I think share repurchases can and do make a lot of sense when you have a company that is trading significantly below its intrinsic value. However, it can be a double-edged sword for a company that maybe is a smaller market cap or, has a large controlling shareholder and doesn't have a large amount of shares in the hands of public investors, because by buying back shares, you can decrease the liquidity of the stock. So I think that it has to be thought about with a long-term view. For larger cap sectors, a share buyback can help boost your share price in the near term. For shipping, I believe it's much more of a longer term capital allocation decision versus assuming a share buyback is going to boost your near term stock price.
But may I add to this that this is exactly the rationale from our side. So we have a set distribution guidance, but given the value dislocation, it is by spending incremental capital on unit buybacks. It's a highly accretive transaction in the end. It's in the interests of our unit holders in terms of EPU, earnings per unit. And at the same time, as long as you don't overdo it, because there's always the risk for micro cap companies and small cap companies like us that you will drain up the liquidity, I think it can be a very powerful tool. So the combination of the two, we find that it is working very well. And one has, I think, to balance these two tools, depending, of course, on where one thinks one is in the cycle.
Yeah, I would just add, I agree with what Christa said. I think you have to look at share buybacks in a long-term, or take a long-term view on share buybacks. I don't think you get immediate valuation kicks. There's no doubt that theoretically, if you're able to buy your shares back at whatever it is, 10, 20, 30% discount to NAV, it sounds like a no-brainer. But I would also add, if you actually run the math, it's really more, you got to go big or go home. You can't just do a $50 million share buyback and expect to move your NAV more than a point or two in most cases. So that would be the only thing I would add with share buybacks. You got to do something significant. And unfortunately, with most of these companies, as Christa pointed out, being more in the small cap arena, you soak up your liquidity in your equity pretty quickly. Having said that, Genco, again, we're very focused on the dividend side. We think you get more bang from your buck in terms of valuation. We'll see how this plays out. I think a lot of these companies have really just put in dividend policies, including us, over the last few quarters. And I do think there's a seasoning that needs to take place on any dividend payer. And we've even looked at Genco, and when we first went public back in 2005, it still took us 3 or 4 quarters to drive down the valuation to a dividend yield in the high single digits. So I still think we have some time to go here, maybe 2 or 3 more quarters before investors get comfortable and with the valuation of again, that 8 to 9% dividend yield, which is ultimately, I think, where we all want to be.
Yeah, and I largely agree with John. I mean, we actually put in a dividend policy in 2019, and we paid 1 dividend. And then, of course, there was a pandemic, and our dividend policy then called for no dividend for several quarters in a row. And of course, more recently, that policy has resulted in large dividends. But we basically do have an authorized share buyback program. We haven't used very much of it, and John, I agree with John that to the extent you buy back shares, you're almost by definition buying from the most liquid pool of shareholding in the market, and so it does tend to dry up liquidity rather rapidly. And it is, in some theoretical sense, a more efficient way to distribute cash than dividends if your share is trading well below net asset value. But all the shipping companies are too small, and basically we need to become sort of solidly mid-cap, I think, at the low point in the cycle before we get really a significant widespread institutional investor base.
If I may, I would like to differ somehow from the others. Ted, in your introduction, you mentioned most of the problems that we are facing today. There's a war going on in Europe. We still feel the effects of COVID around the world. We're going into an inflationary environment with higher interest rates. So we don't feel it's the appropriate time to be making commitments on return on capital. Instead, we are 100% focused on our operations. And from our experience, we have seen that pure play companies, they can pay high dividend at the top of the market and generate healthy cash flows when they generate healthy cash flows, and they make investors happy and their share appreciates. But because we're in a cyclical industry, when the market turns, dividends are reduced or eliminated, shareholders are not so happy, and a lot of them abandon a sinking ship. Then you go into a spiral where the share price drops more. You're in an environment where asset values reduce and leverage increases. The cost of capital goes up. So basically, pure play companies seem to live and die by the cycle. Now, having said that, we do pay a small, modest dividend that has been in place historically at Navios Partners, because we feel that shareholders should be rewarded for keeping the stock. But for us, it's more important to look at the total returns over time. And dividends is just one part of the total return. The share price appreciation is the other part. And our aim is to increase the NAV, which in turn leads to a higher share price. And through the mergers we did last year, we have seen a significant increase in the share price of NMM. So even though we don't pay a high dividend, I think our investors should be very happy.
George,
Ed, I'll just jump in there real quick. I think George has had some good points, and I think Christa brought it up as well. The big problem with this industry is that, as George said, in good times we turn on the dividends, in bad times we turn it off, and that's been very difficult for investors to get their head around and stay with these companies long term. Which I go back to Genco's strategy, which is to really get down to a net debt of zero. And I think we're about 50% of the scrap value of our fleet today, no amort. So when you're talking about cash flow break-evens that are in the low eights, you know, we've gone back to 2000 and looked at all those different markets on a quarterly basis. And there's only a few quarters where you would actually, if you went pure operating cash flow, you would not turn off your dividend. And, you know, that's one of the reasons why we're building a reserve as well, to be able to smooth that out, because our goal is to never, ever turn off that dividend again. And the only way you're actually able to put your hand on your heart and do that is to drive down your debt levels, drive down your cash flow break even. But I do think that it's possible to do it. So with that, I'll disagree a little bit with George, and ultimately, I think that's what drives the valuation of your stock. But it's long term. This is not something that happens, you know, in a week.
No, John, I was gonna, and George, you raised the point, and I was gonna ask, and sort of switching a little bit from the dividends to the low leverage. And I know Genco's position is, I was going to say very low or get to net zero, but I guess the question is that the desire to do that is to maintain a permanent zero or low debt position, reduce your break-even points and pay that debt. And this is a question for the others as well, is that's as opposed to reducing debt so that you may sort of reserve firepower going forward if the cycle changes. And I guess the question, in reducing that debt, do you see a time in the future in the cycle where maybe appropriate to use that leverage again, you know, for growth or for acquisitions, or is the intent to maintain zero or low debt? John, I know,
you know,
well, Ed, let me just,
position is clear on that.
well, it's not as clear as you just made it out, actually. So when I say getting down to net zero, that is our goal for the time being. But what that allows you to do is take advantage of a low market when others cannot buy, you know. So instead of us levering up to 50% at that time, you can get quite a bit of bang for your buck levering up to 20, 25%. and then delevering again in a good market. So it actually puts us into offense throughout any cycle. And that is one of the main goals. And I would also tell you, it also puts you in a position to not have to do rescue equity, which again is, it's one of the pitfalls that almost every company has had to unfortunately go through at certain parts of the cycle. And that's something we want to take off the table going forward.
I would agree with John. If you have low leverage, you can take advantage of opportunities that may come your way by temporarily increasing your leverage. You have room with the banks to play. But there's another important point that I want to make, because as I mentioned, we have reduced our leverage, and we intend to keep this permanently at low levels. For the past 20 to 30 years, we went through a period of very low interest rate environment. And it's obvious that the lower the leverage you have, the lower the effect of an increase in interest rates. I mean, the last few months, we have seen the LIBOR rate go from 0 to 100 basis points. So, and combined with the inflation that we see around the world, most probably this low interest rate environment is changing. So the low leverage, gives you some insurance against higher interest rates.
Yeah, I mean, I think we're bringing our debt down slowly, but at least at the moment, there's no present intention of actually increasing it, at the bottom of a cycle. I think our hope is that over time, our equity can trade well enough, and our leverage can be low enough, and our dividend can be consistent enough that, at the bottom of a cycle, we will still have equity that's attractive relative to the value of the assets and can use that. At least again, at the moment, our thinking is that it is very easy to lever up, but very hard to delever. And, it's a temptation that we hope we will be, financially able to avoid while still growing the company at the bottom of the market.
I guess that talking a little bit and switching back to the other side, onto the equity side, and John, you're saying you don't want to be doing this in distressed equity, but at the same time that we're seeing increasing shareholder distributions and we're seeing the delevering, we're also seeing a number of companies, for example, putting in at the market offerings, not to say that they're using them or not. Christa, maybe to you, I mean, it's sort of what are the conditions that from your perspective, what are the conditions that would make it appropriate to use equity again, and whether that's in a sort of a shares for ships deal or whether it's just a straight, cash equity offerings? Do you see in this market, do you see any opportunity or any situation where that would again make sense for these companies?
That's a really hard question to answer generically, because I do think it's very situation specific in terms of when a company should think about issuing equity. I think that it has to be part of a long-term plan. I do believe, more consolidation will happen across the sector. It takes time. I think using equity in consolidation makes a lot of sense. Ships for shares are just transactions where the seller has agreed to take stock. And that can be a great way to achieve consolidation benefits without coming to the market and doing a capital raise. With respect to ATMs, so these are programs that couldn't get put in place and allow companies to dribble out equity slowly, trading into market volumes. A decade ago, these had a bad reputation in the shipping sector as programs that were put in place to just save companies, created a lot of dilution. At Citi, we have made these programs a tool in the toolkit for many companies that have a strategy of wanting to come and issue equity over time opportunistically. We've helped some of the larger shipping companies use them very effectively over the years, just to have a prospectus on file, be able to come to the markets when the time is right, We've also been able to use them to sell larger blocks of stock when there's an investor who may have an appetite at a specific time, kind of outside the construct of a regular offering. But there's a cost to having them in place, and so it really just has to. We think that they make sense if a company is thinking about adding some equity to its capital stack over the next 12 to 24 months. They can be opportunistic. We don't advocate them as a way to issue large amounts of equity, but they can be a tool in the toolkit. And if you have a program out there and your stock price starts trading really well, it doesn't stop you from doing a larger equity raise. So I think that addressed your question about ATMs. And I know you started out saying kind of more generically, when is the time right? But what's challenging in shipping is that oftentimes valuations are the best when companies don't need capital, and which is why it goes back to the earlier points around balance sheet strategy and capital allocation. And I think the companies here are doing a great job in terms of managing their balance sheets in a way to have that flexibility, so they don't have to come to the equity markets. That's key, because that's when you get in trouble, and it can be very painful.
And Jerry, I know you had mentioned this too. I mean, and issuing equity, it can be for cash, it can be opportunistic. On the LNG acquisitions, you obviously use a combination of cash, shares, and I guess some assumed debt. But what do you, I mean, is the obvious explanation is just that if you're trading above NAV, it makes sense to use equity? Or what are the considerations that go into how much of, for example, of an acquisition would be cash versus equity versus debt?
So I think sometimes NAV is kind of overemphasized as a guide to valuation. There are many different metrics, and NAV is a bit elusive. It can be backward-looking, can be forward-looking. But in the end, it is at least one of the things that you have to take into account when you're looking at funding projects. In our case, because the dislocation between our intrinsic value and our current trading price is quite sizable, I think it is clear that common equity issue is not a particularly attractive proposition. So, we went on and we acquired a fleet of 6 brand new LNG carriers, a $1.2 billion acquisition, and we only issued just $15 million of equity. The rest was secured and unsecured debt. And I think that was, if you also take into account the fact that we had a very under-levered balance sheet at the time, as well as that we acquire assets with long-term charters where you have long-term cash flow visibility. So right now, our cash flow visibility goes beyond 5 years. It is easier to take on some additional debt. The other consideration was, of course, something that my fellow panelists mentioned. We were acquiring these 6 LNG carriers at an average price of $200 million or so, when the industry low was around 180, 185. So, only 5% above the absolute low. So I think residual value and where you're in the cycle is also a good guide, and that can help you decide whether you can incur additional debt. And if you also have the cash flow visibility, you can pay it down. So to cut a long story short, for us, equity, common equity is not really an open path, but hopefully as we build up our equity position and we continue to deliver on our business model, we should be able to bridge that gap and potentially use that tool down the line.
Just one, and I'm recognizing is we are running short on time, but just one sort of general strategy question that we're not talking about here, or at least directly, is that has been discussed, is sort of consolidation in the industry. I mean, is that happening just through vessel acquisitions as opposed to consolidations sort of through M&A activity, Or is that something that any of you sort of see, continuing or in the near future in terms of consolidation, or is that something that's sort of paused?
Well, I mean, in the past 3 years, we've bought about half of our current fleet through, small and medium-sized M&A transactions, using our shares. And the rate of such transactions, the rate of transactions that's crossing our desk has not really slowed down. We haven't closed any recently, but I think, that we'll be able to get some of these done. I mean, we always look at about 10 for every one we close, but I don't think it's stopped or even actually slowed down much.
Okay. We have about 5 minutes left. I'm just looking at some of the questions that do come in from the audience. One of the ones that I think is interesting is there any data as to whether dividends or other shareholder distributions find their way back in to get reinvested into the company? Or is that something that you would, is there any way, I don't know if there's a way to tell what that data is, but that's an expectation.
If we had a dividend reinvestment plan, which is, a specific sort of, securities offering plan, we would know how much was invested through that, but we don't have such a plan. I don't know if any of the other panelists have a dividend reinvestment plan. It's pretty unusual in the shipping industry. In fact, I've never heard of one.
Nope.
I know there's some on the books from many years ago, but I agree they're not very common.
Yeah.
I guess maybe the question is the I guess the way the answer is there's no way to sort of tell where that's going back in, or whether rewarding shareholders comes back and gets reinvested in the industry, or if it goes away. One sort of just, I think, final question that I just like to ask, because it is so prevalent today. I mean, is there anything about the uncertainty about the situation in Ukraine and the sanctions that have come out of that? Is there anything about there, or anything sort of that you see could happen coming out of that would cause any of you to sort of reconsider either strategies or particularly capital allocation policies going forward, or is it just a wait and see attitude?
If I may, I guess from our point of view, it has only reinforced our choice to go into the LNG business. I think one segment that is expected to benefit from all this is LNG and its transportation. At the same time, we have long-term cash flows locked in across our fleet. So really, we don't expect any turbulence there. But as far as the medium to long-term fundamentals of the LNG business, I think they have strengthened, and we will continue to expand in this segment.
Yeah, Ed, from our side, again, this is, I mean, I think Ukraine has helped the dry bulk trade, at least in the short to medium term, with extending ton miles, particularly on the coal side and the grain side. We'll have to see what happens to the grain as we get into the latter part of the year. But again, I go back to this. This is why Genco is set up the way it is. We don't need to change any dividend policy, or even if we have downward volatility because of the leverage profile and the low cash flow break even that we've set up. And that was the goal from day one, to not have to pivot if we have downward volatility. But look, time will tell. Ukraine is I wouldn't put it in the chaos theory bucket at this point, but it is it's very fluid. I mean, there's even been news today, so we'll have to see how that plays out. But from a dividend standpoint, you're not going to see us change our policy.
Just to change the tone slightly, Ted, you should love what's going on now with the sanctions with Russia. I mean, I see in our office the legal department is overwhelmed with the work they have to do, because these are not the usual sanctions against a country or a product. It's against individuals and companies. So you have to be extremely careful in what you carry and how you carry it.
There's a saying, George, that lawyers benefit from all markets. I guess I don't know that in this one, I don't think it's worth the trade, but I understand what you're saying. The sanctions experts have definitely been very busy lately. That's certainly true.
Yeah, I think the Ukrainian situation has given us a new appreciation for the benefits of a pandemic.
Well, Hamish, on that, I think, Nicholas, I think you're about to come on and tell me is that we are just at the end of the time, and I think maybe we'll leave it with that one line. Thank everyone for the time today, and appreciate everyone's participation. And Nicholas, thank you for having us all. I'll turn it back over to you.
Thank you very, very much. This has been, as expected, a very interesting discussion, and thank you for bringing really so much insight to share with our audience. Thank you very, very much to all of you.
Thank you.
Thank you all.
Thank you, Ed. Thank you, Nick.
Thanks, everyone.
Thanks.